Hi, I'm Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. A long-term care annuity can be a great way to protect your retirement accounts from long-term care expenses. But watch out. There are 4 types of annuities that are, in my humble opinion, horrible ways to plan for long-term care. There's one type of long-term care annuity that can leverage your money should you ever need long-term care, and most people have never heard of it. If you're healthy enough, you might even be able to buy one of these long-term care annuities with an unlimited amount of long-term care benefits over your lifetime. Truly catastrophic long-term care coverage. Some people say annuities have high fees. That's true. Annuities have big surrender charges. That's right. Annuities have below market interest rates. Yep. Annuities are mediocre investments. Yes. But my clients don't buy these long-term care annuities as an investment. They buy the long-term care annuities in order to protect their other investments. There are 5 main types of annuities that are often sold as a way to plan for long-term care. I'll explain each type, starting with the worst and leading up to the best. The worst type of annuity to buy for long-term care is an annuity with a rider that waives the surrender charge if you ever need to move to a nursing home. Several years ago, a man emailed me asking me for some quotes on long-term care insurance. I called him about 30 minutes later and he said, "I don't need the quotes anymore. I've already got long-term care insurance." I thought, that was fast. I said that, how did you do it so quickly? And I might be able to get him something better. "What kind of long-term care insurance do you have?" I asked. And he said, "I have 2 $50,000 annuities, and if I need to go to a nursing home, the insurance company will waive the surrender charges, and I can withdraw the money from the annuities to pay for the nursing home." I replied, "That's not really insurance. Insurance is when an insurance company uses its money to pay for your care. All you're doing with the annuity is using your own money to pay for your care. You're not insuring, you're self-insuring." He said, "Well, my insurance agent says this is all I need." I'd heard that before. I continued, "2 $50,000 annuities will not pay for care for very long." And then he said, "Well, then I'll just buy another annuity." I chuckled and I politely hung up the phone. Clearly, he didn't get it. All he had done was take money from the savings account and put it into an annuity. The annuity would grow each year based on whatever interest rate the insurance company was paying at the time, and he would use that money to pay for his care. Clearly, that's not a smart way to plan for long-term care. He probably would have been better off taking the interest earned each year on those annuities to pay the premium for a real, robust, traditional long-term care insurance policy. Or even better yet, a long-term care partnership policy. The second worst type of annuity to use for long-term care planning is an immediate annuity. An immediate annuity is when someone pays a lump sum to an insurance company in exchange for a guaranteed monthly income for life. The older someone is when they buy an immediate annuity, the higher the monthly income. According to annuities.com, a 65-year-old male can pay an insurance company $100,000 in exchange for a guaranteed lifetime income of $621 per month. An 80-year-old male can pay an insurance company $100,000 in exchange for a guaranteed lifetime income of $1,017 per month. The other day I was reading a personal finance forum I visit now and then. One of the topics was, should I buy long-term care insurance or an immediate annuity? The poster wrote, "I'm nearing retirement and I'm at the optimum age for purchasing long-term care insurance. Would it make sense to wait until I get closer to the optimum age of purchasing an immediate annuity, like late 70s or 80s? The immediate annuity income would supplement my pension and Social Security and put me in a decent facility. Immediate annuities can make a lot of sense for someone very concerned about living too long and outliving their other sources of income. The monthly income from an immediate annuity is guaranteed for life. That's the appeal. However, an immediate annuity is not a good solution for long-term care planning. Insurance is all about leverage. Pay a small premium in exchange for a large payout if the loss occurs. An immediate annuity is the opposite of leverage. You pay a large premium in exchange for a small monthly payout, albeit for life. Now, there are some excellent uses of immediate annuities for retirement planning, but long-term care planning is not. The third type of annuity that is not so good for long-term care planning is another type of immediate annuity. This type of annuity doubles your income when long-term care is needed. Sounds great, right? This type of annuity is better than nothing for long-term care planning. However, you're still only getting your money back with some interest, just a little faster than a regular immediate annuity. Using the example from earlier, a 65-year-old male would pay $100,000 to an insurance company to receive a guaranteed $621 per month for as long as he lives. And then, if he needed long-term care, the $621 per month would double to $1,242 per month. Again, I guess that's better than nothing, but $1,242 per month doesn't even cover the cost of 1 or 2 hours of home care each day. For long-term care planning, it's better to keep the money invested in your portfolio and then use some of the interest earned to pay for a robust long-term care insurance policy, rather than just buying a smallish monthly income that could double. The next worst kind of annuity for long-term care is what's called a deferred income annuity, or sometimes called a QLAC. I'll explain. QLAC stands for Qualified Longevity Annuity Contract. It's exactly like a deferred income annuity, except QLACs are funded with money from retirement accounts like traditional IRAs and 401ks. QLACs can be a pretty good way to supplement income later in life and minimize taxes on retirement accounts. However, just like a regular deferred income annuity, QLACs are not a good way to plan for long-term care. They don't provide any leverage. A deferred income annuity is when someone pays a lump sum to an insurance company in exchange for a guaranteed monthly income for life. It's similar to an immediate annuity because it guarantees an income for life. However, the monthly income is deferred until the annuitant reaches a certain age. For example, according to annuities.com, a 65-year-old male can pay an insurance company $100,000 in exchange for a guaranteed lifetime income of $2,037 per month, starting at age 80. Now, deferred income annuities might be a pretty good way of supplementing income later in life. However, these annuities are a horrible way to plan for long-term care. For one, the deferred income annuity will pay nothing if care is needed before the starting age. With traditional long-term care insurance, it provides the entire policy benefits from the very day you're approved and pay your first premium. You don't have to wait. There's no vesting period with long-term care insurance. You don't have to wait many years before you can receive benefits. Secondly, there's no inflation protection in the monthly income. With traditional long-term care insurance, you can buy inflation protection, and the policy benefits will grow each year to try to keep pace with the increasing cost of care. Third, $2,000 a month doesn't cover much care in today's dollars, let alone 15 years from now. For the purposes of long-term care planning, instead of buying a deferred income annuity, wouldn't it make more sense to keep the $100,000 in your investments, use the interest you earn on that to buy a robust, traditional long-term care insurance policy? Of course it would. To learn more and to get a quote, go to my website, ltcshop.com, and click on Policy Finder. Answer a few quick questions, and within one business day, we'll send you the details. Thanks.